This isn't a rally, it's a reset. That sounds dramatic, but here's the contradiction. Prices look like a bubble, yet the forces underneath are described as permanent. And if that's true, the risk isn't buying too high, the risk is assuming things will ever go back. That matters to you because your savings, your timing, and your sense of waiting for a pullback all depend on whether the old floor still exists. The content makes a concrete claim. Since 2020, the M2 money supply expanded by about 40%. That's a fact stated directly. More currency units, same finite resources. The same document contrasts this moment with 1980 when silver spiked during the Hunt Brothers episode and then collapsed. That collapse, it argues, depended on a system that could still snap back. But here's the part nobody says out loud. If prices don't snap back, hesitation becomes exposure. That's the inference. If gold establishes itself at entirely new levels, the old reference points stop working. And once that clicks, the real question isn't how high can this go, it's what exactly broke that makes this irreversible. What's happening now didn't start with prices, it started with structure. The core event, as described in the material, is a shift away from precious metals, behaving like cyclical trades, and toward them functioning as re-rated assets inside a permanently expanded monetary system. The document frames this not as a one-off spike, but as the consequence of years of suppressed pricing, underinvestment, and sudden monetary expansion colliding at once. Gold and silver aren't moving in isolation. Real estate, equities, and commodities are all being forced to reprice against a currency base that has already changed. Here's a specific detail the text emphasizes. During the low price years, capital didn't flow into future supply. Mines weren't developed, exploration slowed, incentives disappeared. That wasn't visible at the time, but it created a delayed effect that's only showing up now. And this is where the framing shifts. Silver is described not just as a store of value, but as an industrial input that gets consumed, not hoarded. Unlike gold, it doesn't come back into vaults. So ask yourself this. If an asset is both scarce and consumable, does it still behave like a speculative trade? Or does it start behaving like something the system can't afford to price cheaply anymore? Here's the strong claim embedded in the material. Silver is no longer priced as a scarce asset. It's priced as if supply can respond. The document backs this with a hard detail. About 75% of global silver supply comes from byproduct mining, not primary silver mines. That's a fact stated directly. Silver is pulled out while mining other metals, often from ore grades struggling to reach 100 grams per ton. As those grades deteriorate, miners have to process more rock for the same amount of metal. Costs rise, flexibility disappears. Now notice what's missing. There's no switch to flip that. Suddenly increases silver output. Byproduct mines don't ramp production just because silver prices rise. They respond to copper, lead, or zinc economics instead. The text contrasts this with rare exceptions. It points to high-grade discoveries in places like British Columbia's Golden Triangle with intercepts of 467 grams per ton over 15 meters. Those exist, but they're geological outliers, not the norm. The fact is that high-grade primary silver assets are becoming rarer, not more common. Here's where the inference locks in. If most supply can't respond to price, and demand keeps pulling metal out of circulation through industrial use, price stops being a signal. It becomes a pressure valve. But here's the part nobody says out loud. Markets still behave as if silver is optional. And that assumption is what sets up the next escalation. This is where the situation stops being theoretical and starts to normalize something that shouldn't feel normal. The material shows how scarcity isn't new, but the response to it is. Silver used to be stockpiled, now it's consumed. Electronics, green energy, industrial components, once silver goes in, it doesn't come back out. That's a structural shift, not a market mood. Historically, when supply tightened, inventories cushioned the blow. That cushion is gone. The text draws an implicit comparison to earlier resource cycles, where shortages triggered investment waves that eventually flooded the market. That release valve no longer works here. Years of suppressed prices meant exploration slowed, high-grade veins were abandoned, and future supply was quietly sacrificed. What used to be a temporary imbalance has hardened into a permanent constraint. Now watch how fast this escalates. The document describes silver as gold on steroids, not as hype but as mechanics. Historically, silver traded at 4 to 6% of gold's value. It's currently described as compressed near 1.5%. That's a concrete distortion, not a feeling. And here's the normalization. Markets are treating this gap as sustainable. But gaps like that don't close gently. They close violently, or all at once. Here's where the evidence gets harder to ignore, because the words and the actions stop lining up. The document introduces a development that quietly changes silver's status. The Reserve Bank of India moves to allow silver to be used as banking collateral. That's a fact stated directly. 10 kilograms of silver are accepted with the same collateral value as 1 kilogram of gold. That implies a state-sanctioned ratio near 10 to 1, far tighter than the market ratio today. Now pause on that. This isn't a hedge fund opinion. This isn't a retail trade. This is a central bank rule change inside one of the world's largest economies. Silver is no longer treated purely as a commodity. It's being elevated into the monetary system. But here's the contradiction. At the same time, silver is being formally remonetized in parts of the global south. Western markets still price it as if it's abundant, as if it's optional, as if substitution is easy. The material also notes accumulation by major non-Western powers, including Russia and China. That's presented as part of a broader strategy to reduce dependence on the dollar system. The action is clear, the messaging elsewhere is not. Here's the line that permanently reframes this. When sovereign systems start treating an asset as money, retail price volatility stops being the main driver. Systemic demand takes over, and once that happens, the pressure shifts somewhere else entirely. Now, the pressure starts stacking fast. The document describes multiple stress points hitting at the same time, not sequentially. First, the Japanese bond market. A concrete detail stands out. The yield on Japan's 30-year government bond surges more than 8.6% in a single session. That kind of move is associated with distressed markets, not a G7 economy. The implication is clear. Control is slipping. Second layer. Japan holds over $1.2 trillion in U.S. treasuries. That's a fact in the text. If domestic instability forces Japan to defend its currency without printing more yen, liquidation becomes one of the few options. Selling U.S. debt doesn't just stay in Tokyo. It transmits stress directly into U.S. yields. Third layer. U.S. yields are already rising. The document points to the 10-year and 30-year both gapping higher at the same time. That's pressure from both ends. Fiscal issuance is accelerating while foreign absorption is weakening. Notice how quickly this compresses decision-making. Central banks lose room, governments lose time, markets lose patience. This is what loss of control looks like. Not a crash, a cascade. And once cascades begin, they don't ask for permission. So ask the uncomfortable question, what happens if this doesn't stabilize? What happens if it spreads? Now bring it back to your life, because this is where the story stops being markets and starts being consequences. If the document's framework is right, this isn't just about a higher silver chart. It's about a world where the currency base expands, supply can't respond, and the system quietly reprices everything around you. That doesn't show up as one dramatic headline. It shows up as daily friction. The text says this is a new normal, meaning previous low baselines don't return. If that's true, then waiting for it to go back becomes a trap you can feel in real time. Rent doesn't rewind. Insurance doesn't rewind. Grocery bills don't rewind. And if assets re-rate upward while purchasing power leaks downward, the biggest psychological damage is that your instincts stop working. Now watch the detail that makes this personal. Silver is not just held, it's used. It flows into electronics and green energy, and it doesn't come back. That means the stuff that drives modern life is consuming the same input investors are trying to protect themselves with. But here's the part nobody is saying out loud. When something is both money and a necessary industrial component, it drags the whole economy into its pricing story. That's when people stop talking about investing and start talking about access. If this feels familiar, say so in the comments, because the next layer is why the system allows this to happen in the first place. The reason this keeps happening isn't chaos, it's incentive. The document strips the emotion out of it and points to a mechanism. Paper markets reward speed, leverage, and abstraction. Physical markets punish all three. Futures can expand infinitely. Physical supply cannot. As long as price discovery is dominated by paper instruments, scarcity stays hidden until it overwhelms the system. Here's the unsettling insight. Suppressed prices weren't an accident. They were a signal. Low prices told producers not to invest, not to explore, not to build future supply. That kept inflation optics clean in the short term, while quietly hollowing out the physical base underneath the economy. At the same time, industrial buyers behave differently from investors. They don't wait for dips, they secure inputs to keep production alive. The document explains that silver demand from industry is inelastic until prices reach extreme levels. That means price pressure doesn't relieve itself gradually, it builds silently. Now notice what this enables. When scarcity finally surfaces, there is no fast fix, no policy lever, no overnight mine. The system can only respond by repricing. That's why this doesn't feel like a normal bull market. It feels delayed, compressed, and inevitable. And once repricing starts, the next move is never where people expect it. From here, the material lays out two paths, and neither is clean. On one path, the system manages the transition. Prices rise, volatility spikes, but institutions adapt. Governments intervene selectively. Central banks tolerate higher inflation rather than trigger debt collapse. Silver and gold continue repricing upward, not in straight lines but in violent steps followed by pauses. In this scenario, the adjustment is painful but controlled. The system bends without breaking. On the other path, coordination fails. Bond markets keep pushing yields higher. Foreign buyers step back. Trade tensions harden into financial retaliation. The document points to how quickly this could accelerate once confidence cracks. In that case, repricing doesn't wait for policy, it forces it. Assets gap higher, not because of enthusiasm, but because currency credibility erodes faster than officials can respond. Here's the key uncertainty. Both paths look similar at first. Rising prices, confusing signals, temporary pullbacks that feel like relief. That's why the next move matters so much. Not the headline move, but the response to it. Because once momentum chooses a direction, the system tends to follow. And that choice may already be forming. Here's the insight that ties everything together. This isn't a story about metals. It's a story about what happens when money expands faster than reality can. The document keeps circling the same quiet conclusion. When currency grows and supply can't, price isn't the problem. It's the message. Gold and silver aren't going up. They're exposing what everything else is measured against. Reframe the entire arc in one sentence. What looks like volatility is actually the system updating its math. And that's why this moment feels unstable. Old reference points no longer work, but new ones haven't fully settled. People keep waiting for the past to return, while the structure underneath has already moved on. The next phase won't announce itself with clarity. It will arrive disguised as noise, pullbacks, and false relief. That's where most people tune out. That's where the real signal forms. If you want to understand what happens next, not after it's obvious, but while it's forming, stay here. Follow, subscribe, and keep going deeper. Because this reset doesn't end with prices. It ends with a new baseline.